So now we turn to the stock market, and we couldn't turn to two better experts than Abby Joseph Cohen, the chief market strategist for Goldman Sachs, and financial writer and analyst Andrew Tobias. I guess the question, ladies and gentlemen, what happens when the market opens on Tuesday? Abby?
Bob, we'll all find out together what happens on Tuesday morning. Basically, however, I think investors are wise to sit back over this weekend and think about the following question. What condition is the U.S. economy in? Granted, there are serious problems in Russia, Brazil, and elsewhere, but we think the U.S. economy is continuing to grow, is continuing to generate jobs, profits, and doing so with very little inflation. That's good news ultimately for the stock market.
Andrew?
Well, my hunch is that things we haven't hit the bottom, either short term or even long term, but nobody knows. And so let me tell you what we do know for sure, or at least what I think I know for sure. I know that people shouldn't have any money in the stock market that they actually will need in the next 5 or maybe even 7 or 8 or 10 years. I know that people shouldn't have any money in the stock market on margin. And I know that people who have money in the stock market but who also have credit card debt or who have car loans at 8 or 10%, in essence, are in the stock market on margin, except it's not even deductible interest. They're paying credit card interest or car loan interest. A good way to make 8 or 10 or 18% tax-free is just to pay off those debts. And the last thing I know is that especially at times when the market isn't going up 20 or 30% a year, the transaction costs and the annual fees that you tend to not care about if you're making so much money, that 1 or 2% a year that maybe the mutual fund or the whatever way it's being siphoned off, becomes tremendously important. So however you invest your money going forward, this is always true, but especially true when the market isn't going to be booming, try to keep those fees and those transaction costs as low as you can.
Let's talk about another issue that people care about, which is what's going to happen to interest rates. Fed Chairman Alan Greenspan has sort of hinted over the weekend that, in fact, there may be an interest rate cut. Abby Cohen, would that be a good thing?
I think that the decline in interest rates has already begun. Let's keep in mind that the Fed determines only some very short-term interest rates, those interest rates which are driven by the markets and which determine things like home mortgage rates and so on have already moved lower as the global economy has gotten somewhat weaker and also as inflation has stayed under very good control.
So what if the Fed moved further to cut rates, though?
I think if the Fed moved further and this was viewed as, let's call it a vitamin B12 shot, something to ensure that the U.S. economy stays in good condition, it would be viewed in a favorable way.
You know, what you say has great bearing, I think, on what the market actually does. There was a time when you were saying you thought this market had top out at, what, 9,300 or something like that. Do you still hold to that?
That was the forecast we put together at the beginning of the year, Bob, and when we did hit those levels earlier this year, we did not raise our year-end target. We thought we would be stuck in a choppy trading range. Well, it was even choppier than we had expected. We think from these levels, the stock market direction is up over the next few months. The only way that the current level of the stock market makes sense is if indeed we are going into a mild recession in the United States, and we don't see that this year or next.
Mr. Tobias, how concerned should we be about the health of the Asian markets right now?
Well, I think we need to be concerned about the health of the Asian markets and the Russian markets and the Latin American markets and even our own, in the sense that a lot of this sort of thing, unfortunately, isn't as quantitative as the rational among us might want it to be. When Roosevelt said, all we have to fear is fear itself, this was a profound economic statement. How do you get the Russians to be confident and to have hope and to kind of organize themselves? How do you, for that matter, get the Malaysians or the Thais or the Japanese and so on? These are issues of leadership and confidence and psychology that are very hard to quantify. And as I think it was Greenspan, Fed Chairman Greenspan said, the notion that none of this is going to spill over and affect our economy is tenuous.
You know, you raise an interesting point. Do we put too much emphasis on the Russian economy and what's going to happen? As somebody said to me the other day, the Russian economy is about the size of the economy of the Netherlands, I think it was.
Well, yes, I mean, the economy is very small, but they do have, 20,000 warheads and so on, and it's something that's always in the news. If something that's always in the news, this is what affects psychology. We have the problems in Russia, the problems in Asia, problems of possibly some sort of terrorist thing. We have leadership problems around the world. We have the year 2000 problem, which is, it may turn out to be nothing, although I don't think so, but going towards the year 2000, more and more people are going to become aware of it. So even if it doesn't have substance, psychologically it will have some. So there's a lot of reason I think, to be concerned. And remember that, you know, in all of history, the first time the stock market, the Dow, using that, ever got up to 6,000 was less than 2 years ago. And even less than that, about 20 months ago, Chairman Greenspan used that phrase, irrational exuberance, not necessarily describing the market, but it caught on. The market was at 6,500. Today is at 7,600. So to have gone up from 6,500 to 7,600 doesn't mean that it's like a terrible low.
Ms. Cohen, let me ask you, do you think that we've been worrying too much about the Russian economy?
I think we have been worrying too much about Russia. The United States does less than 1% of its trade with Russia. But let's keep in mind, one of the things that has happened over the last month is that there were some institutional investors based in the United States who made large investments in Russia and made those investments with borrowed money. When their Russian investments went south, they needed to pay down their debts anyway. And I think that has been one of the reasons we have seen some selling of U.S. stocks.
All right, well, I'm going to thank both of you very much for coming in today on this Labor Day weekend, a very interesting discussion. For in-depth analysis and the latest on the financial markets, visit our website at cbs.marketwatch.com. And I'll be back in just a minute with a final word.